Last chapter. So before I get started, just wanted to mention a couple things. First, I'm not on camera today because things are not looking pretty here today. Like many of you guys, there are just some days where I do not feel like looking nice or even brushing my hair. So I try to avoid the camera those days. So this is Monday when I'm taping it. Some of you are still finishing up your chapters 8 and 9 exams, so I'm not going to say anything about that. Look for an email from me this week where I'll go through some things from that exam. I'll talk about end of semester grading and talk about the final exam and some tools that I have for you guys to help you get ready. One thing I do want to just note is that I know you guys are under a lot of stress. We had a lot of change this semester. Distance learning, it's not for everyone. I'm sure each of your professors do it differently, which doesn't help the matters. And, you're doing it in an environment that you're not used to. So I just want to acknowledge it, tell you I hear you, I understand you, and just try to do the best you can. Depending on when you listen to this, you've got 2 weeks or less left in the semester. So do your best to put your head down, try to grind it out these last 2 weeks and, finish up where you want to for the semester. All right, so let's start this last chapter. How exciting. We made it to the end. All right, let me start my slideshow here. Slideshow from current. All right, so remember, we've done all of our assets, all of the liabilities. Now we're on to equity. Oh, here was a little funny that if we were in class together, you can take a minute and look at it on Instagram. I love Instagram, although now I'm totally addicted to TikTok in this new environment. All right, so equity. I want you guys to picture me standing in front of class holding a beach ball like I did all of the time when we were together when I talked about equity. What makes equity grow? Well, there's only a few things that can make equity grow, right? When people invest in our company or when we have earnings. Things that make it shrink are when we give out dividends or if we have losses instead of earnings. We're also going to learn this chapter about a couple other things that could change it involving repurchasing our own shares. But before I even go into that, let's just talk a minute about, what is equity, right? So remember, if I start a company and I need some cash to finance this company, I can do a couple things. I can go out and borrow money and I have debt, right? And you've learned about the different types of debt. You've learned about installment notes, short-term borrowings, right? Those are the ones that are less than a year. And you've also learned about bonds and long-term borrowings. So that's all the ways we can borrow money and not give up a piece of our company. But we're obligated to make payments and pay interest. So that's a downside. Now with equity, the nice thing is that we don't need to make any type of interest payments. We don't owe anybody this money back. But we have given up a little bit of control, right? So we now have given up partial ownership in our company. So those are the decisions people have to make when they go out and they start their companies up, and even throughout the life of the company. All right, so the different components of equity. Some of this should look familiar because you've done this when you've put your balance sheets together and when you've done your statement of stockholders' equity. Right, common stock, right? That's common stock that we issue to our shareholders. You're going to learn about this new term called par value in this chapter. Preferred stock is something we've not talked about. It's a different class of stock. Treasury stock, we've also not talked about this. This is where we own our own shares, which is kind of weird when you think about it. Like, how can I own myself? Well, we'll get there. Additional paid-in capital, this goes hand in hand with the common stock and the preferred stock. We'll talk about what that means. Other comprehensive income, it's an important component of equity for large corporations, but you know what? We're not going to talk about it in this class because it is very complex. So my accounting major friends, we get to talk about it when we get into intermediate, but the rest of you guys can rest easy knowing you don't have to deal with it. Then retained earnings. Now remember, retained earnings is like where I talk about that holding that beach ball, right? Remember, net income makes it go up. Right? If I had a loss, instead of net income, it'd go down. And then dividends make it go down. So you guys are used to seeing me pretend to hold up that beach ball and show it either growing or shrinking. And again, this is the a sheet you can refer back to. It's reminding you of what makes the equity components change, right? So if I sell stock, right, my common stock's gonna go up. Same with preferred stock. Treasury stock has to do with repurchasing shares. Again, we're gonna ignore other comprehensive income. And we've already talked about retained earnings. Let me just try again to put I hate it when this pencil is on red. Drives me bonkers. Okay, that's better. Here's a snapshot of Snap's 2018 balance sheet. Just want to drive home some of these concepts. So look at their stockholders' equity section. You see Class A non-voting common stock. Ooh, that's a tiny number. But wait, we know they've got more than that. That's because this number refers to par value of the stock. And we're going to talk more about this, but par value is a meaningless amount we assign to shares. And it has to do with some old legislation. It's an antiquated concept. Really doesn't matter to anybody except lawyers and accountants, because we have to break up our journal entries when we record issuing common stock between the actual stock account and the additional paid-in capital account. So you can see that additional paid-in capital account, well, that's $7 billion. Well, gosh, that makes a lot more sense. We know they don't just have 9 million in common shares. They've got a lot more outstanding in the 7 billion. So if I had made a journal entry to receive cash and issue shares, I would debit cash. And I'm going to make these numbers up, but let's just call it for 7 million. My credit would be broken down into two pieces. The first piece would be the common stock, and I'm going to make that entry at par. And par is usually measured either in pennies or dollars, so it's a tiny entry. And then I balance the entry with that paid-in capital. Right, so that's where the bulk of our money when we issue stock goes. Again, here's an example of Snap's statement of stockholders' equity. You can remember with the statement of stockholders' equity, we're rolling forward, right, from the beginning to the end. So the interesting thing you can see here, shares issued in connection with the stock options under stock-based compensation plan. Oh, look, they've issued a lot of shares. Just trying to see if on here it showed when they issued all of those shares to the public. But I'm not seeing it fast enough, and I don't want to waste your time by spending too much time on this slide. Okay, let's get that back down. All right, obviously we won't do our class exercise. Let's start talking about what else is going on in Chapter 10. Now, there's different types of entities when you start an entity, right? You could decide to start a company today. And if that company was a sole proprietorship, there's nothing you need to do, right? So it just means that you've started something up, you've made a name for it, and it's a sole proprietorship, okay? That's the easiest, simplest kind. It's usually one person, they're doing some type of business, and when they file their taxes, they'll note that in a separate schedule on their taxes. As we get more complex, you can have things such as partnerships. Maybe you and your friend want to open up a business together. In those cases, you might form a partnership agreement and then choose to actually form things called limited liability companies, C Corps, and S Corps. Now, we're not going to go into all the details of all of this, nor am I going to test you on all of the types of entities you can have. What I want you to walk away understanding is what are the advantages and disadvantages of if you decide to do a corporation. So a corporation is going to be something that's going to be very regulated. You're filing papers with the state, and the corporation itself becomes a person, right? So I want you to think of that corporation, right, as its own person, right? A corporation becomes an entity unto itself. And what's so powerful about that is now you've limited the liability. If the corporation makes a mistake, only the corporation can be sued. You cannot be sued as a shareholder of the corporation, right? A corporation also gives us the ability to go out and raise additional capital and sell additional shares in a much easier way than continuing to form new partnerships. Now, some of the disadvantages, the reasons people don't do it, corporations get taxed twice, and you'll hear that a lot in your as you go through your various classes. And that's because corporations pay their own income tax, right? Remember, they're their own entities, they're their own people. So they're paying their own income tax. And then they're giving the shareholders dividends. Okay, so now I'm a person, here's Jennifer down here. I get a dividend from a corporation I have shares in, and I pay the income tax on those dividends. So when we talk about double taxation, that's what we mean. Corporations are taxed on their earnings, and then when individuals receive dividends, the individuals are taxed as well. That's the downside. And obviously there's a ton more paperwork. Being a corporation means you got to file a lot of stuff with the state and the federal level. Now inside corporations, we can have two different kinds. We can have public and we can have private. Now let's think about the differences. A public company means I have registered with the SEC. That's our big watchdog, right? These are the people that help protect investors like you and I. The shares of stock can be traded on exchanges, right? So it's highly regulated. Anybody can purchase the shares, allowing public investment, which is really helpful for the companies because it means that the shares are more readily traded. It's easier access to cash by raising additional shares. Now, a private corporation means it's only held by a limited number of people. So let's just say one of you guys and I decided to start up a corporation. We filed all the paperwork. We have a corporation. That's called a private corporation. Until we decide to list it with the SEC, it is private, meaning only shares can be traded between you and I or others that we decide to include. So when you hear about companies doing what's called an IPO, an initial public offering, what they're doing is taking their shares from private to public. Now, not all companies do that. Companies that we've seen do that probably over the course of your lifetime and my lifetime, right? Snap is a big one. Snap took their shares public. WeWork was trying to do it, but they had a big problem. Facebook, that was huge, right? Lots of people became rich when Facebook's IPO came out because the employees that had received shares for working, well, once those shares could be traded in the public domain, they could sell them for large amounts of money. Right? Some companies, they like to be private. That's the way they want to stay. Mars Food, right? So Mars Food and Candy, that's owned, I believe, by a family, and they've decided to keep it private. All right, so let's talk more about the corporation and how it's managed. If we were in the classroom right now, I would ask you, who do you think runs the company? And usually the answer I get, dropped my pen, from students is the CEO runs the company. And that's the most logical answer. But in reality, the shareholders actually run the company. Well, let's think about that. You have companies that have millions of shareholders, right? So you've got millions of people owning shares. Well, you can't have millions of people run a company. So what the shareholders do is they elect the board of directors through something called proxies that come out once a year. The shareholders elect the board of directors, and then the board of directors chooses to hire the CEO and usually has a say in some of the other C-level positions such as CFO, etc. But my point is, the shareholders truly run the organization. They elect the board of directors, who then hires the CEO. You sometimes hear about high-profile issues going on where shareholders are in a proxy war. They're trying to get different people on the board of directors because they want changes in a company. You'll also sometimes hear about board of directors firing their CEO. If you followed the Wells Fargo case at all in the press, right, the board of directors came in, they fired the CEO. It took them, I think, 6 months to hire a new one. But they have the ability to do that. So what rights do the stockholders have? Again, they've got the right to vote. They've got the right to elect the directors and vote on important matters. They've also got the right to receive dividends, but they do not have let me say it differently. They have the right to receive them if the corporation chooses to have a dividend, but companies never have to have a dividend. Like right now, when I'm making this lecture, right, we're in the middle of the COVID virus. Companies might not have the cash to make a dividend, so they'll choose not to. Obviously, we don't like that as shareholders. It might make us change our vote next time it was time for us to elect our board of directors, but that is at the discretion of the company. And then to share in the distribution of assets. So if the company was dissolved, we would stand in line with everybody else and maybe get something back. But remember, as a shareholder, we're the last one on the train, right? So you have, you've got credit holders, right? People that had bonds out there, they're first in line. Then you might have the preferred shareholders, which we'll talk about. And then the common shareholders, they're the last ones on the train. Usually in the event of a dissolution or a bankruptcy, they're going to get nothing. All right, so let's talk about the different types of common stock. And can be an important point. There's 3 terms that I want you to understand: authorized, issued, and outstanding. All right, authorized, we talked about common stock, corporations that have common stock. They have to file a lot of paperwork with the government. They file paperwork and they tell the government what the par value of their stock is. And again, that's just this weird, meaningless term. And then they also choose how many shares to authorize. Honestly, that number doesn't really matter a ton either. They can always go back and authorize more. They might say, I want to authorize 100,000. They might say 10 million. It doesn't matter. There's no value associated with just having authorized shares. Then they would actually issue the shares. So those are what's sold, right? And that's where people like you and I, we hold issued shares. But sometimes we can also own we talked about our own shares. So issued is going to be things that have been sold to third parties and that we still own our own stock. And then outstanding shares means it's just held by third parties. So I think this pie chart does it best. Right? The whole pie is authorized. Right? You're going to have this big portion of unissued down here. Then you're going to have a portion of outstanding. So that's people like you and me, third parties. And you're going to have treasury stock, which is we own ourselves, like we own our own shares. Our own. I'm sure I'm spelling that wrong. Shares. And those two together form issued stock. Why is this so important? Well, treasury stock is a big vehicle companies use to help manage their liquidity. And so when you get into your finance classes, you're going to want to understand that concept, because sometimes it's better for a company to go out and purchase their own shares with cash that they have on hand than it is to invest the cash in something else. All right, let's come back to par value. As I said earlier, par value is just a legal capital amount. People tend to do it as a penny. Sometimes they do it as $1. It's no relationship with market value. It's just a random number we assign to check a legal box that we have a par value. So let's talk about how we account for when we issue no par common stock versus par. Okay. And why might we have no par? Some states don't actually allow a par value assigned. Some states require it. Corporations are established at the state level, not the federal level, and every state has its own rules as to this par value. But as you'll see, par value, again, is just a silly old nuance that we have to deal with when we make our journal entries. So, first case, we have 1,000 shares of no par common stock at $30 a share. I'm going to debit cash for $30,000, which is my 1,000 shares times $30, and I'll credit the common stock account. Easy peasy. I don't even deal with that new account called additional paid-in capital. But if I have par value, I need to break up my credit into 2 pieces. I'm going to debit cash for $1,000. You can see that's unchanged from above. And I'm going to credit 2 pieces. I'm going to credit the common stock account for the par value, right? The penny times 1,000 shares. And then whatever I need to balance the entry goes into this new count, additional paid-in capital. Here's a really important point that I want you to understand. Whether I do this journal entry to common stock, because it's no par, or to common stock and additional paid-in capital, I end up with the exact change impact to equity. Equity in both situations has increased $30,000. because common stock sits in the equity section and additional paid-in capital sits in the equity section. So again, all we're doing with the nuance of par value is splitting that second entry. So I want you guys to take a minute, try to do these two transactions, write out the journal entries for them, and we'll come back and look at it together. All right, so we've issued 1,000 shares of common stock for $50 per share. We have no par common stock. All right, so we know right away we're not going to have to deal with that pesky paid-in capital account. Instead, we're going to just debit cash, credit common stock. On April 1st, we issued an additional 100 shares for $55. Okay, we've got cash that came in at $5,500, and we credit common stock. Now, I'm going to pause here for a second because I want to make an important point. A lot of students say, okay, this is great. I earned $50 when I sold this first batch, and I earned $55 when I sold the second. What if it's now trading on the stock exchange for $100? Doesn't matter. Once I sell my shares to the public, what they choose to do with them and the prices they assign to them doesn't impact the company. The only thing that impacts the company is when they initially sell the shares or if they choose to purchase them back. Right? How people trade that stock doesn't matter. It's almost, it impacts a concept called market capitalization. That's not an accounting concept, it's a finance concept. It doesn't impact our actual financial statements. All right, so let's look at this next one. Now we're issuing something with a par value. We have $1 par value. So we did 1,000 shares at $50 per share. Our debit to cash is the same. We're going to credit common stock just for the par value, right? So that's the dollar times the number of shares, and we balance the entry with paid-in capital. On April 1st, we're going to do the same thing. We're going to issue 100 additional shares for $55, and I've got cash of $5,500. I'm going to credit that common stock for the par, and I'll balance my entry with additional paid-in capital. Whether you did this with the par value or not the par value, again, your total equity change is the same. You just are using two accounts instead of one. Okay, so I'm going to pause there, stop this video, and I'll come back and we'll talk about preferred stock.